This video will tell you all you need to know about mutual funds. Before we begin, please note that mutual funds are subject to market risks and make sure to read all the scheme related documents carefully. Furthermore, the video content has been made for informational and educational purposes only. Nothing contained in this video shall constitute or be deemed to constitute an advice. Always seek the advice of a professional with any questions you may have regarding your financial decisions. Before we get started, here's a brief on what we will be discussing today. A history of the industry, the effects of mutual funds on the economy, key terms to understand, what a mutual fund is, common misconceptions regarding mutual funds, the investment and the redemption process, regulators. Let's get started with the history of the mutual fund industry. In the year 1963, the Reserve Bank of India started the Unit Trust of India or UTI to encourage small investors to save. The UTI had monopoly until 1987 and the industry grew more than 10 times in this period from 600 to about 6,700 crores. In the year 1987, public sector banks such as SBI and PNB started their own mutual funds. It was around this time that the LIC started theirs as well. Private sector funds joined them in the year 1993. Starting from 1996, the industry has been regulated by the Securities and Exchange Board of India or SEBI. In 2009, the entry load was removed and direct plans were introduced in 2012 to lower costs and make mutual funds more accessible to the public. In 2018, mutual fund schemes were recategorized by SEBI. We will delve deeper into this in a few minutes. The industry manages assets worth close to 27 lakh crores as on February 2020. Economic growth has a direct impact on investments. Financial markets always respond to the economy. When economic growth is buoyant, investments flow into the capital markets. Foreign institutions, domestic institutions, and retail investors participate more. This sees the value of the investments rising. Sometimes investment values could rise higher than what the underlying economic growth reflects. When this happens, investors must seek safety and book profits. Sustaining high economic growth for a very long period of time is difficult, and there will be periods where the economy cools down. When the economy slows down, profits take a hit, asset values drop, and investors exit the markets. During this time, returns will be modest until growth picks up again. As you can see, the investment cycle is correlated with the economic cycle. Sometimes the reaction is more aggressive than expected. We can stay ahead of the curve by seeking professional guidance. Before we go further, here are some key terms that you will need to know about. AMC refers to asset management companies. They are the institutions that manage mutual fund schemes. KYC stands for Know Your Customer. This is a regulatory requirement to start investing in mutual funds. NAV stands for Net Asset Value. This is the market value of your mutual fund units. Dividing the total amount invested by the net asset value gives you the number of units held in a particular fund. SIP stands for Systematic Investment Plan. We will delve deeper into this later in the video. Investing a fixed amount as a one-time investment is what is known as a lump sum. Redemption refers to the process of selling your mutual fund units. STP stands for Systematic Transfer Plan and SWP stands for Systematic Withdrawal Plan. These will be explained further in the video. Expense ratio is a percentage of the investment amount paid to the asset management company. Exit load is a penalty levied for premature closure. It is usually levied if the investment is redeemed within 1 year. Benchmarks are a way to compare the fund's performance with the market. TRI stands for Total Returns Index. It calculates the value of the index with the dividends reinvested so as to give a fair comparison. A fact sheet is given by the AMC to the investors at the end of each month. It contains details of their mutual funds.
What is a mutual fund? A mutual fund is an investment vehicle which consists of a basket of funds from various investors to invest in bonds, stocks, etc. It's important to note that every mutual fund is unique and different and has its own investment objective and mandate to adhere to. We shall be covering this later in the video. Now, let us look at some of the misconceptions of mutual funds. High risk and volatile. This is not completely true. First, we need to understand what you perceive as an individual as risk and what are the types of mutual funds you invest in. As mentioned earlier, not all funds are the same. It would be best to work with a professional to understand this better. Mutual funds are liquid in nature. Based on the funds you invest in, the money redeemed will be available in the bank account in 1 to 3 business days. There are multiple types of mutual funds which invest in low risk instrument, making it suitable for conservative investors too. The markets always fluctuate between two extreme moods of guaranteed returns and low pessimistic return. Complementing your SIP portfolio with gradual incremental lump sum infusions will help you over the long run for wealth creation. It's crucial to understand the risks involved in direct equity as you're exposed to a single company, whereas in a mutual fund, risks are relatively minimized as it's a pool of companies. For many people, mutual funds could be difficult to understand and interpret, which is why it would be prudent to work with a professional to ensure you're rightly informed. Lastly, people feel fixed deposits are always better, but they are not very tax efficient and are also exposed to interest rate risk, which is often an ignored aspect. Now, let's look at how an investment process works. So, first, the investor decides to buy a mutual fund. He has a choice of either going through a distributor or the AMC directly. There are some KYC requirements that need to be completed mandatorily, after which the investor will transfer the money to specific funds in the AMC. Then the fund manager of the chosen fund will deploy the money into the assets. And once that is done, the investor is allotted units. Now let's also look at how the redemption process works. So first the investor decides to redeem his units. So he approaches the distributor or the AMC that he worked with. They in order intimate the fund manager to sell the assets to generate liquidity, and this comes back into the investor's bank account as money. There are two regulators in India who regulate the mutual fund industry. One is AMFI, which is Association of Mutual Funds in India, and the other is SEBI, which is Securities Exchange Board of India. AMFI was incorporated in 1995 and aims to promote ethical and professional growth of the mutual fund industry. And SEBI is India's financial markets regulator.